Volatile sessions are where trading assumptions are tested. When markets accelerate, liquidity thins, and order flow spikes, traders stop paying attention to indicators and start watching behavior. In 2026, execution stability during these moments has become one of the most important qualities of any trading platform. This is why volatile session behavior increasingly shapes trader opinion long after the charts have cooled. During low volatility periods, most platforms appear reliable. Orders fill quickly, spreads stay tight, and systems operate comfortably within capacity. Volatility removes that margin for error. Fast markets compress time and stress infrastructure simultaneously. Price moves faster than manual intervention. Order volume spikes suddenly. Liquidity providers adjust exposure in real time. Under these conditions, execution quality becomes visible. In high volatility sessions, traders consistently focus on a small set of signals. Execution consistency. Do orders fill within expected slippage ranges, or does execution degrade unpredictably? Order handling behavior. Are stop loss and limit orders respected, or do they trigger inconsistently during spikes? Latency under load. Does the platform remain responsive, or does order submission lag as volume increases? Spread dynamics. Do spreads widen gradually in line with market conditions or jump erratically without explanation? These factors matter more than any feature list because they directly affect realized risk. Experienced traders understand that instant execution is unrealistic during extreme volatility. What they value instead is stability, predictable changes in execution behavior, transparent spread expansion, consistent treatment of orders across sessions, communication when internal risk controls activate. A platform that slows slightly but behaves consistently often earns more trust than one that is fast one moment and erratic the next. After volatile moves, traders frequently conclude that their strategy failed. In reality, the distortion often occurs at the execution layer. Slippage expands beyond modeled risk. Partial fills alter position size. Margin parameters adjust mid-trade. Order queues lengthen under load. None of these invalidate the strategy logic. They reflect infrastructure constraints reacting to stress. This is why post-volatility reviews tend to focus on execution rather than analysis. In discussions around volatile session performance, Enterprise 2U is most often referenced in the context of execution consistency rather than features. Traders evaluating the platform typically focus on how orders behave during fast markets, whether execution remains aligned with stated conditions, and how deviations are communicated when volatility increases. This reflects the broader market shift toward valuing predictable execution under stress. Rather than chasing perfect fills, experienced traders adapt their behavior, reducing size during known high-risk windows, widening stops to account for execution variability, testing platforms specifically during news-driven volatility, separating strategy evaluation from execution performance. Some traders now treat execution reliability as a variable, not a given. Markets are faster, more automated, and more sensitive to liquidity shifts than ever before. Volatility is no longer an exception. It is part of the baseline environment. Platforms that demonstrate consistent execution under pressure tend to become long-term tools. Those that perform well only in ideal conditions are gradually filtered out. Execution under stress is where trust is earned quietly or lost permanently. When markets move fast, traders don't remember dashboards or indicators. They remember whether orders behaved as expected, whether execution degraded predictably, and whether the platform stayed functional when pressure was highest. In 2026, stability during volatility isn't a bonus feature. It's the foundation of credibility.